Ladies and gentlemen, good day and welcome to the RBL Bank Limited Q1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. R. Subramanya Kumar, Managing Director and CEO of RBL Bank. Thank you, and over to you, Mr. Kumar.
Thank you very much. Good evening, ladies and gentlemen, and I thank all of you for joining us for the discussion on RBL Bank's the financial result for the first quarter FY23. I am joined on this call by Mr. Rajiv Ahuja and other members of our management team, who along with me will address any questions that you have. I am sure, given the events over the last 1 month or more so, there are quite a few questions on your mind. I'll make an attempt to address the key ones, and then of course we'll have a Q&A session as well. First, on asset quality. As you can see from the numbers which is there in front of you, our asset quality position continues to be an improving trend quarter on quarter. And I hope this lays to rest any concerns on any large stressed book. Secondly, on growth and the bank's focus on cards and microfinance. One of my important focus area is to ensure profitable growth with continuity. For the bank of our size, we have developed niche presence and scale in credit cards and microfinance, and these will continue to remain the focus area. Having said that, we would like to expand our product suite to be able to cater to the more holistic requirement of our growing customer base. We have a base of around 11.5 million customers, which is getting added at the rate of 0.15 million per quarter. So this customer base is coming from urban India through liability products and credit cards, from rural India through the large microfinance customer base and distribution network we have built. So a natural corollary will be to expand the product line and new product. So we will continue to invest in these products with an aim to reach a critical size over the next 2 to 3 years. We are a growing bank with aspirations, and the more we widen our product offering, the more growth engines we will have, leading to better mining and serviceability of our customers. We specifically would want to focus in the areas of vehicles, housing, small business lending, and other retail products to build the niche areas. Some of the products which are capital light and other things, we will be rolling it out as we move forward. This quarter, our growth has been muted, specifically in microfinance, as we passed consciously to implement the new regulatory guidelines. And in the past, I understand we have been understandably cautious given the external environment, the pandemic. But we will look to grow meaningfully from here on. To give you some context around this, we had around 700 crores of disbursal in our retail business in Q1. This will be around 3x in Q2 and improve every quarter thereon. I want to also briefly touch on my first impression of the bank and my focus areas. My first impressions have been very positive on the quality and the depth in the management, the financial strength of the bank, solidity of the platform across rural and urban India, and like I said earlier, there are interesting business where there is a scale and profitability. My key areas would be to provide clarity and focus on execution of the management's plan and provide guidance from my experience in commercial banking, retail banking, technology, MSME, and rural business, etc. Taking an outside-in view, while there have been a success, the full potential of the platform has not been achieved. My focus would be to drive the bank towards that. In essence, leverage the present and build for a higher profitable future. I have been impressed by the digital capabilities that have been built and the market recognition we have received. The focus will be to drive digital to drive incremental growth in the customers and reduce operating cost. As we invest in the business we want to scale, we will also invest in hiring the necessary skill sets to add to the management depth, and shall optimally utilize the branch network for retail asset business growth. the same breath, I wanted to tell you about the existing depth. The existing depth is average 8 years of experience in the bank. They understand the business which they are heading it thoroughly, and they continue to excel in their area and provide a lever for the growth. And lastly, I will take opportunity to build relationship through transparent dialogue with all the stakeholders and continue to build trust and credibility. In the very short term, we will consolidate, leverage, and optimize the existing infrastructure so that we are able to expand and accelerate in the next 2 to 3 years time frame. With that, I will briefly touch upon the results of this quarter, starting with asset quality. As I said earlier, our asset quality position continues to improve. GNPA and NNPA as of the quarter end were 4.08% and 1.16%, trending lower than QOQ. You know about it, how much is lower than the last quarter. Gross slippages this quarter was 653 crores. Adjusted for recoveries and upgrades, which continue to be strong, net slippages this quarter was 273 crores. Of the gross slippages in this quarter, 228 crores was in credit cards, 133 crores in microfinance, and 205 crores in rest of the retail. Slippages in the wholesale was around 87 crores. Our restructured advances stood at 1,739 crores, against which we are carrying 323 crores. The provisions. We took a total provision advances, NPA, restructured and standard asset provisions of 329 crores in this quarter, as against 534 crores of last quarter. We had recoveries from written off accounts to the tune of 80 crores. Net provision advances, therefore, was lower at 249 as against 392 of last quarter. We have also given the details in our presentation. I'm sure you would have seen that on slide 22 for more details. As a result of this provisioning, our PCR is now 72.52% as against 70.44% of last quarter. We expect credit costs to be markedly lower in FY23, and we expect recoveries from the stressed accounts across wholesale and retail to continue. Coming to deposits and liability, coming to deposits and liquidity. Summarizing the quarter, YOY trends were healthy with the total deposit growing to 6%, CASA growing by 14%, retail and small business growing 6%. CASA ratio was 36%, retail and small business deposit ratio 39.7 at the end of the quarter. Our liquidity level continues to remain high with the LCR of 149%. Our cost of deposit was 4.84% for the quarter. Given our credit deposit ratio, which is around 76%, we have a portion of the wholesale advances to highly rated large corporates. While we may not grow the overall deposit number meaningfully over the remainder of the year, the focus will be entirely on growing the small retail deposits. This means that the proportion of the retail will be far higher in the overall deposit. The run rate of retail deposit gradually will outpace the run rate of other deposits, which is the wholesale. This should be set up well to absorb the surplus liquidity we have been carrying and increase the pace of the retail deposit acquisition, which will be essential as we continue to drive asset growth in next year. This will also positively impact the margins as we run down the excess liquidity over the course of the year. Briefly on advances. Overall advances grew by 7% YOY and flat sequentially. Retail advances declined 5% YOY and 3% sequentially, primarily due to the rundown of microfinance book, as I mentioned earlier. But the wholesale advances grew 22% YOY and 4% sequentially. The advances mix with the retail and wholesale stood at 49. I said earlier, we will start correcting this from Q2 as the retail growth resumes. On capital, we have sequentially improved our capital ratios, where in total capital was gone up from 16.82 as of March 22 to 17.51 as of June. We completed our $10 million Tier 2 capital, which has also improved the CRAR. Development Finance Corporation, an arm of US government's investment in the bank, is a strong endorsement of the platform. Briefly on our operating performance, NII grew by 6% to 1,028 crores. Other income was 614 crores for the quarter. Lower YOY as treasury gains this quarter were lower given the rate cycle. The total revenue was 1,641 crores this quarter, flat sequentially and marginally 100 bps higher than last year. Our OPEX This quarter was 1,112 crores, primarily driven by expenses in the cards, retail branches, and tech costs. Mostly I will consider it as an investment for the purpose of our journey for the growth as we plan ahead. PPOP this quarter was at 529 crores, and profit after tax was 201 crore for the quarter versus 198 crores of last quarter. Now briefly on our retail business. First, on advances and disbursements. Advances declined 5% YOY and 3% QOQ is on retail. However, we saw YOY growth in advances in cards by 17%, home loans by 65%, tractor loan by over 700%. Of course, it's a low base. We saw a decline in micro banking by 36% in the quarter. The bank paused disbursements in April and May in this business to carry out the required process amendments to ensure we are fully compliant with the new regulations. More specifically, to ensure we have an end-to-end 100% digital process. Today we have achieved it, and the disbursement has started in mid of June. Disbursement started second half of June. We are already back to our pre-COVID run rate in July. As I said earlier, retail advances in Q2 will see a sharp increase, primarily as we ramp up the microfinance, business loan, home loan, and rural vehicles during Q2. How are we seeing things today? Markets are upbeat and are providing an opportunity for growth across all business segments. In urban market, we are seeing a healthy uptick in credit cards and home loans. In the business lending segment, the demand is back with the opening up of the economy, but we are being careful in deciding which business to lend depending on the leverage levels. Recovery post-COVID and the performance through the COVID. In rural markets, we see buoyancy in demand across microfinance and rural vehicle loan segments. Slippages. I would like to touch upon the slippages of the retail book. Total gross slippage in Q1 were at 566 crores versus 546 crores in Q4. The net slippage post upgrades and recovery was 225 crores, lower than 257 crores in Q4 of last year. Card slippage was at a normal level, 228 crores versus 201 of Q4 last year. Cards GNPA for FY22 was 2.4%. In FY23, we expect the GNPA to be in the ballpark range of 1.8% in FY23 and credit cost to be around 4.5%. In rest of the retail loans, while we saw gross slippage of 205 crores, net slippage of 12 crores, the large majority of the upgrades from slippages is related to the impact of out-of-order criteria. In micro banking, as indicated in our earlier calls, we are seeing a lower gross slippages sequentially in Q1 F23 of 133 crores versus Q4 of 163 crores. As I said earlier, collection efficiency have shown significant improvement, and we are seeing these customers stabilize in the existing delinquency buckets. Recoveries and upgrades continue, and as a result, net slippages were 36 crores. The book originated FY21 onwards is running at the collection efficiency of 99.6%, and this gives us a confidence that most markets are now stable and back to pre-COVID level. This book now accounts for 81% of the standard book. We are also seeing almost 40% of NPA borrowers paying now, as we expect the recoveries from NPA pool to continue. Although they continue to be in NPA, but 40% of them are paying one installment to the other. The restructuring book in retail was at 1,503 crores in Q1, as against which we are carrying 217 crores of provisions. The business momentum. We issued, under credit cards, we issued 4.3 lakh cards in Q1, maintaining the run rate from Q4. The retail spends in credit cards also continue to show the robust growth, and Q1 has shown a growth of 54% YOY, though of a lower base last year post second COVID wave. Q1 total spends were around 13,161 crore, again the highest ever. All this growth, like we have said earlier, is coming in retail spends, as we have a negligible corporate cards portfolio. Microfinance, as mentioned earlier, disbursals in microfinance were muted in Q1 FY23 at 23 crores. Starting July, we are now back to the run rate of 500 to 600 crores per month. So we should be seeing a sharp uptick in Q2 under microfinance disbursals. On other retail business, the business traction in the secured business loans, home loans, and rural vehicles continue to see a pick up in Q1. We expect this to ramp up further in Q2 onwards. Our rural vehicle business, especially, which is an end-to-end digital offering, is performing well, and we are looking to grow this 3x this year Of course, it's at a low base. I will end my speech by reiterating some of the points I touched upon at the beginning of the call. Our asset quality position is improving, and we expect this to continue. Our credit cost will also be sharply lower this year. Profitable growth with continuity and executing on our plans is the key focus, and you will see progress on both in the coming quarters. Deposit focus will be on the growing granular deposit, even as we run off surplus liquidity. Capital position continues to be robust, and we don't envisage any equity capital for at least next 18 to 24 months. I will stop here, and with this, we will now take the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Anand. Please go ahead.
Hello.
Hi.
Thanks for the opportunity, sir, and congratulations. I just want to understand as to what is happening on operating profit. The operating profitability of the bank has actually come down significantly, both YOY and quarter on quarter. Can you please explain what's happening on that front?
Yeah, I'll ask JD.
Yeah, so one of the challenges we've had is we've not seen growth in our interest-bearing book, and it's been for multiple reasons, COVID issues and other aspects, and therefore that book has been, therefore the interest income or the net interest income has remained at similar levels. Also because of lack of momentum in new disbursements on retail, which also was conscious partly, the fee income has been subdued in terms of processing fee and other fee that comes with disbursement. At the same time, we've been investing in branches, technology, and other such things where costs have gone up. And till the time we get to a certain scale, which will come, in my judgment, between Q3, Q4 timeframe, operating profit will remain little subdued. It will grow, but it will remain subdued. And therefore, the profitability is really coming from, sharp reduction in provisioning, which will also continue.
So what kind of operating profitability can we see going ahead? Can we reach the Q1 last year FY22 level operating profitability at some time in Q3, Q4? Is that what you're suggesting?
Yeah, I think that should be a fair estimate, yes.
The second question is that we have, for our size of bank, we are actually carrying a lot of excess liquidity. Now, this liquidity, will it also impact our, treasury yields, or like how our treasury performs? Is it going to impact us in the coming quarters?
No, Anand, so we are not carrying risk on that. It is typically deployed in reverse repo type situation. So it is an extremely short dated. So there's no interest rate risk we are carrying. We would have built some position now, but not commensurate with the excess liquidity that you're seeing.
How do you see treasury going forward? Like, because in this quarter we only had half of the quarter since which the rate increase should be calculated for. So how do you see this going ahead? Do you see another muted treasury, or do you see losses on the treasury side going ahead for the next quarter or so?
So in Q1 we had a decent treasury income from a pure fixed income perspective, despite the fact that rates went up. So we had positioned ourselves light. From here on, it is unlikely that we will see losses, but one can never say. So it is not going to be an outsized gain situation for the rest of the year because of rising interest rates generally.
But we should not see any significant losses also coming from treasury. Is that like a fair assessment?
Yeah. So for our size of the bank and the book, we really don't carry large positions either way.
Okay. My next question is that, I remember I had gone through our Q3 and Q4 conference calls where we suggested that we're going to grow at 20%, roughly around 20% for this year. Our Q1 has been pretty much, a stagnant kind of a quarter. How do we see, in order to achieve this 20% kind of a number, we need to actually accelerate much faster from here on? How do you see that happening? And plus, how do you see our MFI portfolio going ahead?
Yeah. I'll just tell you, Mr. Anand.
Just 1 second. The MFI, other banks who are into MFI lending are actually growing very fast. Just to add that. Yeah, so go ahead, sir. Sorry.
Okay. Just coming to the MFI, since you made a comparison with other banks, as I said very clearly that we paused, whereas how other banks did during that period, I'm not commenting about it. But however, what we did was that we were very, very conscious of the fact that it has to be end-to-end digital. We had to strengthen our collection mechanism and that of our underwriting skills. So with this particular thing has been completed, as I said that we have already seen in July, we have touched the pre-COVID level of disbursement. With this disbursement continuing, we are confident that we will be able to surpass even what we have been doing it in the earlier months, and we will be able to achieve what we have planned for in microfinance. Second one, with regard to that growth over in 2020, we still hold the same view. Only thing is there will be a movement of which particular segment is going to give the growth. If I look at the retail, with the existing product of the card as well as the microfinance, and with the new product line which we have said about the tractor, agri and vehicle finance, we will be in a position to annualize growth in next 3 quarters to the tune of around 20-25% is given. That we'll be able to achieve it. With the moderate growth in wholesale, overall the credit growth will be somewhere to the tune of around 15-18%. That is what has been assured. We will be able to achieve that with our plan of action.
Great, sir.
Thank you.
Hello?
Yes, the next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello?
Hi.
Please go ahead, sir.
Thank you very much, sir, for the opportunity. Sir, I just wanted to understand, you mentioned on the operating profit, right? It to remain subdued and to reach first quarter level of operating profit by fourth quarter of FY23. So can you just repeat or clarify on that front?
Yeah, basically what I mentioned was that we've not been growing, interest-bearing loans. There has been challenges like microfinance degrew quite substantially in Q1, as I said. But we will need some time to claw back on that, and therefore the level of operating profit which we had in the past as a run rate, it will take us 3 to 4 quarters to get there.
3 to 4 quarters, right? So quarter on quarter we'll see some improvement in operating profit. Will that be a fair assumption to make?
See, honestly, I think please don't box us into such precise numbers. So we are only saying that we will have steady-ish kind of operating profit for a while before it starts inching up.
Steady-ish kind of. So that, okay, understood. But reaching, I think, 700, 750 crores, it will take 3 to 4 quarters, right? In terms of operating profit.
Yeah, that would be a fair estimate, yes.
That would be a fair estimate to me. Understood. And sir, in terms of your credit cost in FY23, you mentioned it to be lower than FY22. So are we looking at 1.5 to 2% kind of a credit cost range in this year, FY23?
We would, I would say we should be less than half of what we had last year in terms of absolute.
Less than half in terms of absolute number.
Yeah.
Hello?
Yeah, that's correct.
Okay. And lastly, on the cost to income ratio, I mean, cost to income ratio has seen a stark jump, right, to 67, 68%. So how do we see that? Is it because of the denominator effect?
So Deepak, that's a function of operating profit, right? Till we get our income right and the costs, stable. I mean, the jaws have to open up, which will take, as we discussed, 3 to 4 quarters.
Okay. Yeah, of course. Yeah.
Okay. You also said about the investment we made in respect of the expenses, no? We have done technology and other things. So given that and the revenue is stable, so maybe that operating profit when it kicks up, this will also get adjusted.
Fair enough. I got the point. Yep. That's it from my side. All the way, sir. Thank you.
Thank you.
Thanks, Deepak.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi. So a couple of questions. Now, firstly, in terms of the operating cost, if you can just highlight in terms of the incremental cost which is coming in, maybe like say 100 odd crores in the other operating cost, and even like 30 odd crores coming in on the employee front. So what is, no doubt you alluded in general as to what is leading to that, but precise number would really help in terms of how much is maybe of the incremental growth, how much is coming, say, from the technology towards the volume related, and maybe any new business or new product segment initiatives which we have been taking. So that would be really helpful, yeah.
Yeah, so Kunal, on one clarification on employee costs, there is a disclosure in our SEBI release. We have this time taken entire ESOP costs through P&L. So if you recall, the RBI circular came sometime last year, where material risk takers and control functions ESOPs given to these people were supposed to be taken through P&L basis fair value, whereas prior to that, everyone operated on the intrinsic value method. So what we have done this quarter is we've now moved to all employees, all ESOP costs through P&L, and we also had to therefore catch up from 1st April 2021 for last fiscal in this Q1. So that amount is approximately 22-23 crores, which is unusual bump in Q1. But having said that, now the ESOP costs will go through P&L. So that's one. Second, of course, we've been investing in newer businesses like we mentioned, rural vehicle business. We are also investing in mortgages, which we need to set up branches, people, hire leadership, etc. in terms of regional leadership. So all those costs, when you are building up newer business, costs will be upfronted, income will come later. And third is credit cards continues to grow, so that typically adds to 50 to 60 crores a quarter in terms of cost, but then that gets somewhat compensated by the income as well from cards. In terms of specifics around how much variable, how much for tech, I don't think I'm carrying that level of details, Kunal, right now. We will have to have that discussion offline.
Yeah, no, so just broadly wanted to understand in terms of is larger part of investment still done, or we will see it to be elevated because maybe newer businesses, some investments would have been done, but I think not a significant part would have been done this quarter. And as we go and launch more and more products and try to scale it up, in fact, this will keep on going up from the current level.
Which is why I mentioned that operating profit to start increasing will take us some time, right? So which is an indication that income and expense will grow along similar levels for at least a couple of quarters before the jaws start opening up.
Sure. And secondly, overall, broadly, we are targeting many segments, but maybe from the management perspective, what would be the priorities out there? And overall, if we can just know in terms of how would we see the mix, say 2-3 years down the line, and any rejig in the portfolio which we will try to do in terms of scaling down any part of the portfolio, say quite substantially from the current level.
See, this journey, if you look at it in 2 to 3 years, initially in the short run, we will be protecting the turf in retail in respect of the credit and microfinance. Thereafter, they'll continue to grow, but the run rate in respect of the other products which we wanted to increase. First one is the housing loan. The second one is the vehicle loan. The vehicle loan we wanted to define into 2 different parts. One is that the commercial, one is that used vehicle, another new vehicle. And then we have a rural two-wheeler. Then we'll be expanding ourselves into some of the products like the rural consumption products, and we will also be going in for a capital light products as we move forward, so that we are able to leverage the growth as well as the NIM can be easily managed over there.
Okay. And one last question in terms of the moment on the restructured side, if you can just explain in terms of how much would have actually slipped into GNPA, how much would have got recovered or written off? And what is leading to a higher recoveries, and from which segments are we seeing the recoveries and the recoveries from the written off account as well? Yeah.
So Kunal, approximately restructuring book reduction would have come approximately 50-50 from reduction in principal and slippage into NPA. Recoveries are coming from everywhere. We've had corporate recoveries, we have MFI recoveries, we've had credit card recoveries. So that's coming from all segments.
Okay, so nothing specific and nothing chunky out there in the
No, not really.
Okay, yeah. Thanks, yeah. Thanks a lot.
Thank you. The next question is from the line of Ashish Kumar from Infinity Alternatives. Please go ahead.
Thank you. Hi, Jaideep. A couple of things. One is that, as you mentioned, that the recovery on the PPOP operating profit will take 3-4 quarters. As a management team, when do you believe we can kind of start looking back at, let's say, double-digit ROE numbers? Would it be fair to say 4 quarters down the line?
No, Ashish.
Rajesh.
I think at this stage, given what we've seen in the last 18-24 months, I think we will take some time to kind of lay out that plan for a double-digit ROE in terms of time frame and how. Early days yet.
And maybe what will be helpful is, and I think just taking out from what the last speaker talked about, is that maybe 3 years down the line, how do you expect the bank to kind of pan out? Maybe as things settle down over the next couple of months, if we can try and understand a guidance as to what the bank will look 3 years down the line, and what kind of an ROE profile would that entail? That would be very helpful. That's a request from the investors, because a lot has changed in the last 18-24 months.
Agreed. Leave it with us. We will come back.
Sure. Thanks, Jaideep, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Alpesh from IIFL Securities. Please go ahead.
Hey, hi, good evening. Few questions from my side. In between, there was some network issue, so sorry if it's repetition. But sequentially, I see that investment book has grown significantly on a QQ basis. Any specific reason for that?
No, actually, this is just liquidity getting parked. There is no other reason.
No, but 25% QOQ increase, I don't know whether in case there is any issue with the numbers, but almost 23-24% QOQ increase in the investment book seems to be quite higher. Is anything related to the repo transactions with RBI or something like that? Because that number seems to be quite high.
No, I'm not aware of anything unusual. I will come back to you offline. There is nothing specific that we've added to the investment book as such.
Okay.
Hey, Alpesh, Rajiv here.
Yeah, hi, Rajiv.
So, hi. We squared off all our long-dated securities well before the April policy. Okay. So after that, we went majorly into the short end of the market and up to 1-year T-bills. Look, we've been sitting on a lot of liquidity over May, June. So that has been parked. We also raised about 800 crores of Tier 2. You know, that was incremental liquidity somewhere around mid-May. So that also, I mean, and if you've seen the growth rate of our advances is being muted. So I think all of this is frankly excess liquidity we've been carrying. I don't think there's anything which is very specific. So Jaideep is just checking the numbers, he'll let you know.
Yeah, Alpesh, sorry, if you look where cash balances with RBI has come down, so we would have just moved from reverse repo to with RBI to shorter dated securities. So okay. If you look at both those together, you will find nothing unusual to combine.
Okay, and now as the things are stabilizing for us, what's your outlook on keeping the excess liquidity on the balance sheet? Because LCR is still at around almost 150%, right? So where do you see it stabilizing? Or by when do you expect to reach by around 110, 120%?
If you just recall what I said in my narration and commentary, we said that we will be in a position to gradually just run down the liquidity over this period for the two-pronged strategy. One, we wanted to maintain that deposit, whatever we are having into the current position, but there will be, the composition will change from that of the bulk deposit to the retail granular. So there will be a movement within that deposit portfolio itself. So, but at the same time, we wanted to grow our retail, which we said that maybe in Q2, Q3, the growth will be approximately at the annualized rate of around 25%, which will consume a part of the liquidity as we move forward. And we feel that by end of this year, we will be in a position to consume a major part of the liquidity what we have without any stress on the need for maintaining that.
So, sir, in that case, if I summarize everything, liquidity coming down, that there will be increase into the high-yielding loans into our balance sheet and some bulk deposits also running off. So, is it fair to assume that every quarter from here on we will see a sequential improvement in margins?
Yeah, Alpesh, I think quantum of improvement, I will not want to hazard a guess, but yes, the trend will be on the upward side, yes.
Okay. Jaideep, also, can you just remind me what was the one-off in the 4Q? Because there was certain restructured loan-related interest accounting that happened in the 4Q in the interest line item. So, and what was the quantum of it? And if you adjust for it, what's the sequential drop in the margin?
No, so yeah, if we adjust for that 90 odd crores, then there is flattish margins. That was essentially, Alpesh, we had not taken interest income on our restructured book in Q1, Q2, Q3, substantially Q2, Q3 because restructuring started in Q2, Q3, which then we were guided by auditors to actually take it to income, and then of course we took that opportunity to provide heavily, and so that was approximately 90 odd crores.
Okay,
and if
now
you adjust for that, then sequentially flat. Okay,
got it. And just last question from my side, it's related to the provisioning guidance that you guys gave. Last year, full year was around 2,800 crores, right? And for the full year, you are saying that it would be half of that, but still it works out to be almost 1,400, anywhere between 1,400, 1,500 crores. Our 1Q number itself is around 250 crores per se. And logically, since the things are improving for us, what is leading us to give a aggressive or very conservative guidance per se, which is higher than even the 1Q run rate of around 250 crores?
So, Alpesh, we said less than half. We haven't said half. And I will leave it at that.
Okay, great. Thank you, and all the best. But any specific concern on the asset quality that you see that could lead to a higher charge? Because see, last year 1Q we had almost 600 crores of in our PNL, right?
We are essentially there is a restructuring book which will come out. Part of it has come out in Q1. Part of it, a substantial chunk will come out in Q2 and Q3. We are just wanting to be a little cautious there.
It just primary link chal raha hai kya?
Excuse me, sorry, yeah. So that is it, but I'm not suggesting that we are talking about 50% or 49% or 48%. It will be lower. It will be somewhere between the run rate and less than half kind of a range.
Okay, great. Thanks, and all the best.
Thank you. The next question is from the line of Zai from B&K Securities. Please go ahead.
Yeah, hi sir, this is Jay Mundra from B&K Securities. Congratulations, Subramania sir, on your MD appointment. Sir, if you can comment any change already happened or envisaged change in the senior management team. While in your opening remarks you had mentioned that there is a decent depth, but if you can comment on, is there already change or maybe over the next 6-12 months, do you envisage any change there?
Yeah, as I said, when I joined this bank itself, I wish to continue to work with the team which has been already anchored themselves in the last 1 decade. When I look at that depth of that management today, they are the first layer and second layer, the heads of various departments are well entrenched in the respective area. They have it, and we will continue to work with them. And only thing is, wherever we are taking expansion, wherever we are venturing into the new area of business, we will be looking at some of the skill set which we will be hiring it, which also I said about it. So we are not averse to hiring the skills, while I assure you that I don't think that there will be a change in the management team. The current team which is heading it are well entrenched in their area of operation. Each of them average 8 to 10 years of service, all of them are having it. They know that the bank, the DNA fairly well, and I'm very comfortable with the team, their knowledge level and the depth and commitment.
Right. Okay. And sir, in your opening remarks, you mentioned that the bank, of course, I mean, this would be the prudent strategy also to, consolidate and then re-accelerate. And I think you had mentioned that rural businesses and some of the secured businesses will probably be getting more focus. Could you highlight a few areas where you would actually want to go slow? Or, considering the current trend, it looks like MFI business is undergoing a bit of a pressure. So any 2-3 areas where you would like to consolidate and then have a relook and then maybe, re-accelerate?
When I said about the consolidation, I said the current book and its run rate, which will be happening in the last 1 year, you would have seen that it is more or less a flat or muted growth. That particular thing is not going to be there as we move forward. There will be a growth acceleration that takes place after, for example, you take the microfinance. We consolidated in last 1 or 2 months, 3 months rather, wherein we said that we will put end-to-end the control on it, but then once it is there, the engine will start firing. That's all those. Same way we are trying to do it in respect of every other area. The bank has already done it. Then another assessment what has been done is that there are 3 different channels which we observed as the one which can propel the growth. One is that the branch channel, second is the digital channel, the third will be that of the BC channel. The BC channel, all the 3 channels will be individually consolidated and leveraged. So you know for sure that the digital channel cannot start delivering it unless otherwise the consolidation of the platform and take some time for leveraging the platform. This is what I was meaning that. The third one is there is nothing like one area is going to be slowed down or one area else, where the bank has already created niche in respect to the credit card and microfinance, and already it has started doing well in tractor loan and agricultural loan, and those will be ramped up, and especially the one which is at the low base will be ramped up at a faster rate. So whatever is doing in respect of areas where there is already an established one, that will be strengthened, and the growth will be continued in those areas also. When we do this, parallelly we will be identifying some of these new products and services which we will be in a position to roll out. That we will identify and then prepare the platform for that, and thereafter we will start accelerating after maybe a couple of quarters forward.
Right, sir. Because I just remember that you said that capital light products would be more favorable. So if you can highlight, let's say specifically for credit card, would this proportion of this business, would it be similar or would it be higher, or it can potentially decline over the next 1-2 years?
And we are mixing 2 issues here. When I said about the capital light product, I said moving forward, when we wanted to identify the products for launching which is going to expand, that is going to be the capital light, because we said that we are not going to look for the capital for the next 18 to 24 months. We wanted to optimize. So you take the case of the housing loan. I mean, the housing loan is one good product where we will be in a position to go forward, and it is going to be risk weight is low. Similarly, there are so many other products we are looking at it. Maybe that I'll share with you once the product line is ready, and then we are ready to launch it. All those retail products will be. I also said that we'll leverage the existing platform. So we have a branch channel, we have a BC channel. We'll be able to leverage for selling or making this product to reach the customers. And I also said that our customer base is a mix of urban and rural. So we wanted to launch a product which is suitable to both the segments.
Right. Yeah, and that is all from my side, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Rajakumar Vaidyanathan, an individual investor. Please go ahead.
Yeah, thanks for the opportunity. Can you hear me?
Yes, Mr. Rajkumar. Thank you.
Yeah. Sir, I have just a couple of questions. So if I see your update on the advances and deposits, I see that your advances have gone up by 7% year on year, and within that retail has come down by 5% and wholesale has gone up by 22%. Right? But if I see your income line, Q on Q, the income line is kind of static. Between June 21 and June 22. And if you see your 10-year GSEC, that itself has moved from 6 to 7.5. That is about 20% more. But why is your income line is static? I mean, I'm not able to marry the balance sheet growth vis-a-vis the income line.
See, you look at our product line, we said that the microfinance is degrowth to the tune of around 36% in last year, which is one of the high NIM product where the revenue stream is higher. Whereas in respect of the corporate loan, where we have shown a 22% over year and around 7% sequentially. So that particular thing, if you look at it, that is, I mean, I will not say that a normal or no loaning. So the revenue firing products in the last 1 year were not high. So those products which are, the credit card is the one which is continues to be performing, and this also had a small blip in the last year during the pandemic period. And in respect of this microfinance, we consciously did not do the business for the simple reason that we wanted to comply with all the regulatory compliance. So these two things just brought down our revenue stream. So in that absence, you see this mismatch because of this reason. But this is going to be corrected as we move forward. As I said very clearly that we wanted to ramp up. And already in July, our microfinance already touched the pre-COVID level of disbursement. And we are confident that with the new regulation setup and new digital platform which has been established, we will be able to ramp up that also to cover up the gaps which we lost it. So the revenue stream has been opened up. That's why Jaideep in his response is very clear that it will take a couple of quarters ahead for achieving the revenue stream what we have been planning to achieve. Thereafter, this correction will take place.
Okay. And sir, how about your expenses? Your expenses are moved by 30% again Q on Q. So it would be helpful if you are doing some correction on the income side, then there should be a corresponding drop on the expenses as well, right? So we can't take a 30% hike in expenses and corresponding drop in the income side. That is what I mean. It kind of shows the DNA of the bank has changed from what it was in June 21. So I just want to know whether the DNA of the bank will be retained or we are going to be more conservative when it comes to the advance side.
No, advance, I said it very clear that annualized growth of around 20 to 25% in respect of the retail, which I don't think that by any streams are conservative. And when it comes to the total growth, I said that it is between 15 to 18%, which in the given circumstances is definitely something which, although I don't call it as an aggressive, it is a very decent number which we wanted to post it. While the cost you said about 30% increase, it was well explained. It is a one-off case in respect of the employee cost which has been accounted for when the ESOP accounting principle has been changed. The second one was that fair amount of investment has gone in credit card, and it was explained that credit card is a business where the continuous investment has to be made. When you ramp up the number of the cards, you have to spend that money. Of course, it will come back to us in the form of profit. And the third point is that the technology and other related investment is continuing to go. You know that pretty well when you open up a couple of new products, there has to be an investment. Last year, 80 branches were opened and the branches have to be ramped up for providing it. Now, having invested in those things, all these channels are to be leveraged. And we will be in a position to enable these channels to contribute in respect of a CASA deposit or the granular retail deposit, and enabling the bank to ramp up their retail advances, which consisting of 4 or 5 products which I told you about. So it is something a combination of both. So it doesn't indicate that the credit is not going. Credit is definitely going.
Okay. So how about the last time the DNA of the bank, has the DNA of the bank changed from what it was a year before from a risk standpoint?
Yeah, we have crossed that bridge and we have come out of it and everything is left behind. Pandemic is behind us and whatever we have been stabilization or rather addressing the struggle has also gone behind. You would have seen that last year the provision which has been made was, I would rather say that last year the cleanup effort has taken place, which definitely brought the book to the current stage. Now the book and the platform has been stationed for the growth. So this is the starting point of it. Rather, it started in the month of July itself. And moving forward, you will see the growth. The growth cannot be high speed. It's a gradual growth in a couple of quarters, and where you will start seeing the momentum gaining as we move forward.
Okay, sir. Thank you. Thanks for the opportunity, sir.
Thank you.
Thank you. The next question is from the line of Mohit Surana from CLSA. Please go ahead.
Hello.
Hello. Yes, Rana.
Yeah, hi. Yeah, hi, sir. Thanks for taking my questions. I have 2 questions. First is on your breakup of fixed rate and floating rate loans. So if you can give the breakup and if you can clarify, the extent of repricing that has been passed on the floating rate loans. So if there is a lead lag between the benchmark and the loan pricing. So, and if you can also give us some sort of a guidance or your thought process on the margin trajectory, because you've guided that the operating profit will take a couple of quarters to normalize. So if you can also give us your thoughts on the NIM trajectory. And the second question really is about, in the bank has in the past spoken about recalibration in the business banking segment in terms of moving towards more secured assets and runoff in the maybe the unsecured piece of that business. So is that recalibration in this business over now, and what's the growth outlook in this segment?
First question I'll ask Jaideep to answer that.
Yeah.
The floating rate mix.
So Mohit, apart from cards and microfinance and maybe a small part of wholesale loans, the book is pretty much floating. So I would say somewhere between 65 to 70%, 65% or so would be floating. What is fixed is, of course, high-yielding cards and microfinance. The wholesale book is largely floating on benchmarks like MIBOR or T-bills, whereas the retail book is floating on repo. The retail book reprices, all repricing happens, and then of course we have approximately about 15% of our loan book which is on MCLR, which is the legacy book which continues. So MCLR gets repriced depending on the benchmark of 3 months, 6 months or 1 year, whereas repo and T-bill typically reprice every 3 months. So some of the repricing of the 90 basis points hike in repo and corresponding hikes that we've seen in benchmarks like T-bills and MIBOR is happened, and some will happen in this quarter. Having said that, with all these pulls and pushes, we believe margins trajectory should be improving as we go forward from here on.
Yes. Coming to the recalibration part, what you talked about it, and we said that we will be focusing on secured asset in respect of the products and services, products and the product line which we wanted to unfold as we move forward. It doesn't mean that overall we are going to shrink the unsecured portion. Unsecured portion will continue to grow the rate at which it is growing, whereas the other secured portion will grow at a higher rate. So when the total size of the book is going to increase, the proportionately, if you look at it, the portion will look like, it will be balanced as you move forward in 2 to 3 years' time.
Sure, sir. Thanks for your response.
Thank you. The next question is from the line of Shubhranshu Mishra from UBS. Please go ahead.
Hi, sir. Thank you for the opportunity. A couple of questions on the credit card portfolio. First of all, what's the steady state ROA that we make on this particular portfolio? Second is, what's the outstanding from the Bajaj Finance customers and from other sourced customers? And what is the incremental mix that we are getting from Bajaj Finance versus others? And the third would be, given the fact that Bajaj Finance is also thinking of sourcing it from having a co-brand with other banks, are we also thinking or are in the pipeline of having various other co-brands apart from Bajaj Finance? So these are my 3 questions, sir. Thank you.
Yeah. Anshu, on the first one, steady state ROAs, let me put it this way. We had achieved ROAs pre-COVID in the range of 4 plus or thereabouts. And I think we should head in that direction over the next few quarters. On the mix between Bajaj Finance and other partner source cards, we would be approximately 50, 50 or 55-45 in favor of Bajaj. Incrementally, in terms of number of cards, we will probably be a little more skewed towards Bajaj than the book. And what was the next question? And yes, of course, while Bajaj Finance has gone ahead and tied up with another bank, we've always anyway been doing partnerships. So we've of course, our partnerships continue with Zomato, Book My Show, ET Money, Paisa Bazaar, Bank Bazaar kind of products. And we will continue to add partnerships. We are, and of course, we are also now giving a lot more trust to our own branch customers, because now somewhere we are getting to some sort of critical size in terms of our liability customers as well. So all those growth engines will continue and accelerate.
Right. Thank you for that. Just to clarify, the 4% steady state is on the credit card portfolio, right?
Yeah, correct.
Right. And just to, if I can squeeze in one last question, sir, do we have any kind of plans to take advantage of the present regulatory conundrum around the PPI? Are we in talks with a few of the fintechs issuing the PPI?
Yes, this bank, if you look at it, it is having one great advantage vis-a-vis the rest of the folks in this particular space. See, we are known for rather the first chance for any of these fintech companies is always to work with us. We will continue to work on. That's what I said, that we wanted to leverage the digital platform which we have already established. Maybe that the work is in progress, and we will definitely continue to maintain our leadership position in respect of these types.
Sure. Thank you so much. Best of luck.
Thank you. The next question is from the line of Anurag Mantri from Eastbridge Advisors Private Limited. Please go ahead.
Yeah, hi. I just had one question on the MFI disclosures that you have on your deck, slide 45, where you show the ticket size for the outstanding and the new loan. So I think this outstanding balance that you show is on a per loan basis, right? Because each borrower also, as per the databases, seems to have about almost 1.8 to 2 loans. So the outstanding per borrower is actually larger, almost double. Just was curious that, why is the ticket size on the new loans almost double of the outstanding on the balance? Is it that, incrementally, like for one borrower is having 2 loans, instead of that, you guys are doing like a larger loan, or, the outstanding loans per borrower sort of remains, and on each loan, the ticket is higher?
Yeah, so let me clarify. The outstanding is also a function of, if you haven't grown in general and the repayments have kept coming, right? So the proportion of new disbursements is less today than it was, let's say, 3 months back or 6 months back, because the book has come down. The chart on the left, which indicates average ticket size, is we don't have multiple loans to a borrower. So that's a single loan.
Got it. So, the deduction from this is that the outstanding on the new is much higher than on the balance, because the balance is also on the reducing balance basis.
Correct, because I think the moment we start originating significantly higher, there will be a convergence between outstanding and new to some extent.
Understood. Thank you.
Thank you. We now conclude the Q&A session. If you have any further questions, please contact RBL Bank Limited via email at ir@rblbank.com.
Thank you.
On behalf of RBL Bank Limited, we thank you for joining us this evening. You may now disconnect your lines.